Hi everybody, welcome back to the channel. Thank you so much for tuning into this video. And today we're talking about actually an ETF that was brought to my attention by a subscriber. They brought this one to my attention. It's Exit the System BTC. I saw your comment in my last video and you were interested in having me make a video on this ETF. So thank you for bringing this to my attention. And if you guys do have any recommendations that you want to see or anything that you guys want to check out or have me review or analyze, leave them in the comments on any of my videos. I do look at those, and I thank you for Exit the System BTC for this recommendation. I've never actually heard of this ETF until you brought it to my attention. And one thing you did mention is that this is kind of under the radar, right? Or it's not as popular of an ETF as some other ones out there. So with that being said, the Defiance S&P 500 Target Income ETF is what we're talking about today. And the first thing to remember here is that this is a relatively new ETF. So it's been around for less than 1 year. Now, since then, we've basically been floating around $20 a share. So the share price itself has not really done a whole lot. We've gotten down to, I think, $18 a share is where we came in August of 2024. But just remember, guys, this is not even 1 year old yet. Okay, so we are still looking at an ETF that is very new. It's basically an infant or a baby in the ETF world. And as the name implies, Defiance S&P 500 Target Income Fund, this ETF is all focused on income. And as you can see from this chart here, same thing. Now, one thing you notice are these D's down at the bottom. That's a dividend that's been paid out every single month. And as you'll see, they've been very consistent in terms of these dividends, paying them out. And as you can see, here's the first day of trading right here back in March of 2024. And we've basically just been trading sideways ever since. Now, if we kind of look at some of this down here, you can see the dividend, according to the trailing 12 months, 16.88%. If we look at the assets under management, we have 110 million in assets under management right now. So, you know, they're building more assets, I think, as it gains popularity, right? Supply and demand, you have that redemption and creation mechanism with ETFs. And so they're continuing to build assets under management as the popularity of the ETF increases. Now, this one is based upon the S&P 500 as it implies. I didn't mean to click on that, but SPYT, as the name implies, defines S&P 500 Target Income ETF. It's basically, you know, as you see, U.S. options and S&P 500. So you have those keywords right there where my mouse is hovering. And so that's basically the focus. Now, according to FinViz, the expense ratio is 0.94%. We can compare this expense ratio to the actual website of the ETF when we go over it. But 0.94% is not cheap. You know, that's something to consider here. A lot of ETFs these days are going to be under 10 basis points. Vanguard ETFs in particular give you exposure to the S&P 500, give you exposure to the broad stock market, but we're looking at an expense ratio that is much lower than something like this. So yes, you're focused on a specific strategy, you're focused on income, and you know, some of these ETFs will charge more because they believe they have a proprietary product or they have a, you know, specific methodology that is better or different than the typical S&P 500 index fund. And so that's just something to keep in mind with a lot of these different ETF companies. You might see elevated expense ratios depending on the strategy. And when we look at the actual website for this ETF, you can see here it has all the information. It's a distribution frequency of monthly, as we saw here with these payouts every single month since inception. They have not missed. And so if we look at the distribution rate according to the website, it's 20.06%. That's as of January 31st, 2025. So specifically, according to the website for this ETF, they aim to achieve a target annual income of 20% in the S&P 500 using options, and they're trying to pay this out every single month. And so what we're looking at here is, according to the strategy, we have an ETF that is dedicated to generating current income. The strategy revolves around holding shares of ETFs that track the S&P 500 performance and also engage in the selling of daily credit call spreads on the index. And so the hope is that they can enhance the yield and they can grow the yield by basically, you know, utilizing the options call strategy or selling covered calls while also buying another call option at a higher strike price. And so this continuous process of selling a call option while also buying another call option at a higher strike price and also focusing on these short-term options instead of like a long-term type option spread. They're focused on short-term spreads basically doing this again and again, trying to offer that enhanced yield compared to traditional option-based strategies. So instead of just utilizing a covered call or selling a covered call, they want to try to increase that income even further by really focusing in on the option strategy that they're employing. Now, as you can see here, according to this income generation, SPYT's investment approach is meticulously designed to generate income through option premiums derived from selling index call spreads, the primary driver of the fund's yield. We sell at the money or near the money call spreads to retain upside growth potential and aim for a target annual income level of 20%. And so it says each day SPYT sells credit call spreads on the S&P 500, prioritizing options with near-term expiration. This entails selling call options at or near the money strike prices and buying call options above that strike price. And so should the S&P 500 value rise above the upper strike price, SPYT stands to profit from further upside appreciation in the index's value. So this is just a fancy way of saying that there is the possibility of gaining on the upside, right? They can, in fact, gain income and potentially also participate in some of the upside of the S&P 500. And it all depends on exactly what happens, right? They're doing this on a short-term basis. Remember, they're utilizing a call spread, and there is risk. There's always risk with something like this. And so it's not just going to be, you get the income and then the share price goes up long-term and you're good to go. As we've seen so far, this has been a relatively flat share price, and that's as the S&P 500 has been rising. So just keep that in mind. These funds, although they're good for yield, a lot of times they're not good for share price growth. And we'll have to see how this plays out over the next couple of years. But so far what we've seen is a relatively flat share price, even though the S&P 500 has been going up over the last year, and we have been in a bull market. But with that being said, we can learn more about this ETF down here. As you can see, they have about 110 million shares outstanding. If we look at the expense ratio, now according to FinViz, that's why I wanted to compare some of these numbers, because it says the expense ratio is 0.94%, but according to the actual website, which I would probably rely on more than FinViz, is 0.87%. So 0.87 is actually better than 0.94%. We want the expense ratio to be as low as possible, obviously, but it's not crazy. It's not a crazy expense ratio, but I've seen a lot cheaper. And so just remember that as well. You are paying a bit more for an ETF like this than if you were to, say, invest in a Vanguard S&P 500 index fund that has an expense ratio of less than 10 basis points. So always something to consider there, because those funds can add up over time. Now, if we look at here, the top holdings for this ETF, what it's actually investing in, right? It looks like what we are investing in here is IVV, the iShares Core S&P 500 ETF. It looks like pretty much all of the net asset value is in that ETF. And what they're doing is probably utilizing that ETF and then, doing the call spreads against it. And then, because it's basically an index fund, right? If we look up IVV, we can probably find the chart for it and everything. And, iShares Core S&P 500 ETF, as you can see. So it's tracking the S&P 500. Now you'll see that it's up 22.74%. So this one, it's getting about 20% yields, but where's the upside? There really is no upside for the Defiance S&P 500 income fund, even though the S&P 500 is up over 22%. So that is a trade-off. But if we come on over here to the actual dividends, if you're in retirement and you're looking at income, and one thing I wanted to talk about is, how much could you actually make if you wanted to, let's say, make $1,000 a month? How much would you have to invest, right? Well, we have a 20% yield essentially. And as you'll see, these dividends are pretty consistent. We have a dividend here of 0.34, 0.33. Basically, these dividends are over 30 cents per share paid monthly, and we have that consistency to the point where I wouldn't say just always expect to get 30 cents a share, but so far we've had that consistency and we've had those dividends that have been paid out. And so even though it's not an exact science, as you can see, there is some variability in terms of these dividends. We have seen that we've been paid out every month and we've been getting at least 30 cents a share. So I'm going to go ahead and assume that the target yield for this is going to be 20%. Now, if we're looking to get up to $1,000 a month, the question is how much would you have to invest? And this calculation can be done a couple of ways. One way is we can kind of just throw in a number here. If we take the current share price of, let's call it $19.50 to make it easy. Right now it's at $19.39, but we'll just say $19.50. And if we wanted to, get, let's say, 1,000 shares of this ETF at $19.50, how much would that cost? That'd cost about $20,000. Now we're going to need a little bit more than that, believe me, to make over $1,000 a month from an ETF like this. But let's multiply that by 5. Okay, so now we're at about $100,000 that we're putting into this ETF. Now, at the current price of $19.50, how many shares does that get us? 5,000 shares. So we have 5,000 shares of this ETF, and we're not putting in, any kind of chump change here. We're putting in about 100 grand to this ETF, and how much are we getting back? As of the most recent dividend, or even if we just assume 30 cents in dividends per month, how much are we getting? Well, that's over $1,500 per month right there. So we've already hit our goal, right? And that was with 5,000 shares of this ETF. So once again, 5,000 shares times $19.50 gets us, that's how much you have to put in. But with that, if you do the math on how much we're actually making with 5,000 shares times a 30-cent dividend to make it easy, that's $1,500 per month. Now, let's say we put in $75,000 into this ETF, and we want to try to get that $1,000 per month cash flow at $19.50. We're looking at 3,846 shares at a 30-cent dividend per month, $1,153. Take away some money for taxes or whatever if you're pulling it out of your retirement account, 10%, whatever, if you're doing an early retirement thing. You get the idea. You're still over $1,000 a month. So that's kind of what you can look at. $75,000 to $100,000 into an ETF like this. It's no small chunk of change, but that's what you could look at if you're really getting serious about dividends and cash flow, especially in retirement. You can look at this and say, I can make over $1,000 per month from this if I invest this much. If I put in, let's say, 3,500 shares or even 3,000 shares, if we take, 30-cent dividends, we're looking at $900 a month, right? So it kind of gives you an idea. If you buy 3,000 shares of this ETF at $19.50, how much is that, right? How much would it take, or how much would you have to invest? On the low end, we're talking like 60 grand. On the high end, let's say if you want to get up to like $1,500 plus per month, you're looking at about 100 grand into this ETF, and that's with a 20% yield. So anyway, guys, this ETF is interesting. I do find it interesting that we have consistency. One thing I like about this is the consistency, the monthly dividends. Also, so far the share price is nice and flat. It hasn't really gone down. The lowest we've gotten is $18 back in August, but it bounced right back. And so what will happen over the next couple of years? If the S&P 500 goes down, what will happen? How will this ETF perform long term? Will the yield actually go up if we see the market go down, and will that help to compensate for any potential downside in the share price of the ETF? These are all questions to ask yourself, in addition to the expense ratio as we discussed, in addition to really just your own risk tolerance and investing goals. What are you focused on? What do you really want to achieve, and how do you want to achieve it, right? Are you more focused on cash flow, or are you more focused on growth in terms of, maybe taking more risk to get a higher, share price return on a stock or something like that? That's just, it's just all things to consider here. But if you guys like this video, hit that like button, hit that subscribe button if you guys want to see more content like this. Consider hitting that notification bell so you don't miss out on any of these types of videos if you guys did like this. And thank you once again for Exit the System BTC for this recommendation, because I had no idea about this ETF until you mentioned this, and I do find it interesting. I think it is kind of maybe under the radar, you could say, in terms of ETFs. Like, for example, I had no idea about this one, and it looks like, from what I can see, the consistency of dividends is something that is very positive about this. I would say that's very positive. One of the downsides, or maybe the potential negatives, is that we do have kind of a flat share price here, and that you are not going to see the actual returns of the S&P 500 in terms of the share price. As you can see, we're up 22% on the IVV, which this is basically tracking or utilizing. But there's just a trade-off in terms of either cash flow or if you want more of like share price growth. And so that's just something to consider. But with that being said, guys, thank you so much for tuning in. God bless you all. We will see you in the next video. And yeah, take care.